Hey everyone, Coach Investor back on our earnings report for you today. So let's talk about Disney's earnings report. And I also wrote down a couple of things that were mentioned during the earnings call that I think you should pay attention to it. Now, I'll start by saying that they again reiterated that they're going to issue a modest dividend by the end of the year. When they mentioned that, plus the fact that they will focus on long-term growth in free cash flow, suddenly the stock went from down 1 to 2% to up 3 to 4%. I guess the boomers still love their little dividend. Now, Disney lost a lot of subscribers this quarter. Are you surprised? No, I'm not. They're also going to crack down on account sharing, a bit like Netflix. But the difference between Netflix and Disney is that Netflix has content. Lots and lots of content. Disney Plus? Yes, I do like my old Disney movies, but the current content, let's be honest, it's not really quality content. And are you going to pay extra for that? Because there are going to be more price hikes, by the way. Of course, that could increase average revenue per subscriber. But if that will force people to cancel their subscription, how's that going to work? Well, funny enough, they want people to cancel their premium subscription. Well, they don't mind if people cancel their premium subscription if that means that they'll flock to the ad-supported tier. Because the ad-supported tier, the pricing there will not change. And so they're banking on the fact that people will cancel the premium subscription and then go and subscribe to the ad-supported one. Pretty peculiar strategy if you ask me. But hey, let's have a look at the report. Then at the end, we're going to have a look at the graph as well. So revenue is up 4% year over year. If you look at total segment operating income, that's basically flat. Net income, here again, a loss from continuing operation, $460 million. Diluted EPS excluding certain items, $1.03, that's down 6% year over year. Cash provided by continuing operation, that's up 46% to $2.8 billion. Free cash flow, $1.63 billion. I believe last quarter was closer to $2 billion. So there is that. But again, they will focus on long-term growth when it comes to free cash flow. They also said that they'll spend less on content, around $27 billion there, mainly because of lower spend on produced content and probably also because of the strike that is happening now. There will be a shift in timing of those expenses. And that's why CapEx is $5 billion for the year. Now, with regards to ESPN, they did say that they will retain full control of ESPN despite very, very high interest to partner with them, have strategic partnerships with maybe leagues or some other companies out there, entities out there. Now, the reason why they're looking and having those talks right now, two reasons they gave us. One is increased content, and two, content distribution, marketing spend distribution, etc., will be made easier and also more efficient with partnerships. Who will that be? How will that work? Remains to be seen. Then when it comes to the different segments, so Disney Media and Entertainment Distribution, that's down 1% year over year to $14 billion. The parks, yet again, are carrying the whole load here, so up 13% to $8.32 billion. When you look at operating income, same story there. Disney Media and Entertainment down 18%. Parks up 11%. They've also seen great growth in Shanghai parks. Well, not surprised there since last year it was only open for around 3 days or so in this quarter. And so in the Disney Media and Entertainment Distribution segment, linear network down 7%. We're not surprised. Direct to consumer increased just 9%. Then for operating income, linear networks down 23% year over year. Direct to consumer has improved 52% year over year, but it's still a loss. Now, with regards to making direct to consumer, so the streaming business, more profitable in the future, they did mention a couple of things. While it was asked on the call whether or not they'll stop, maybe be available in certain countries, stop spending money in certain countries as well, maybe invest in other countries more because it is more profitable. And they did say exactly that. Not all countries are created equally, something like that, meaning In some countries where they know they're going to be more profitable, they're going to create more content, spend more content there. And then in some other countries that are maybe not profitable at all for them, just not create anything. So some markets will have lots of investments, others less, and then others none. Makes sense if you want to make this a scalable and profitable thing, because they do say that they want to have Netflix-like margins. Well, what a surprise, right? Laughing at Netflix way of working for years and years and now falling behind and wishing you had the margins of Netflix. I mean, should have done better work earlier on. Moving up to the subscribers. And this is where the issues begin. So Disney Plus, domestic United States and Canada, that's down 1% year over year. International, excluding Disney Plus Hotstar, that's up 2%. And then Disney Core is up just 1% to 105.7 million. Now, you have here Disney Plus and Hotstar, huge decrease year over year, of course. It's not very profitable for them there, but still, huge decrease. Now, if you add those two segments, right, Disney Plus and Hotstar, plus Disney Plus and Core, which, by the way, usually they gave you that number, right? Disney Plus Global, they did not give us this number this quarter. Guess why? Well, because it's down 11 million quarter over quarter. So, of course, they don't want you to see this visually. No company is removing good numbers from an earnings report, good metrics from an earnings report. Usually, when you hide some numbers, when you change the way you provide the numbers in an earnings report, it's because you're trying to hide something. Now, of course, we can just do 1 plus 1, so we add this to this. It's 146. Last quarter was 157 million. Then, when we look at the average monthly revenue per paid subscriber, there you can see some increases, of course, that's logical after price hikes. You see some increases there, which also probably led to the huge decrease here in Hotstar because, well, pricing is pretty sensitive in those countries. So overall, if we had here the Disney Plus Global, we would see a change positively year over year. As for ESPN Plus, that's down 3%. Hulu SVOD only up 6%, and Live TV plus SVOD down just 1%. But here again, you can see what happens when you have ads. Well, the revenue is much higher, which again, you can go back to the point of not having such a big issue with people canceling their premium subscription and then going to the ad-supported one. Then with regards to the cruises, so growth in Disney Cruise Line was due to an increase in passenger cruise days, partially offset by higher costs associated with our ongoing fleet expansion and increased depreciation. And I think they said during the call that they're going to add 2 extra ships because of the huge success there and the demand. Now, with regards to revenue in parks and experiences, so domestically that increased 4% year over year. Internationally, huge growth there, 94%. When you look at consumer products, that's actually down 3%. They say here that that's because of low revenue from merchandise based on Star Wars, Toy Story, and Avengers. I wonder why. And when it comes to operating income, domestically, that's down 13% year over year. Internationally, well, it was negative last year. It's now positive $428. So that's quite nice. And so if we go and look at the graph currently, these are the same drawings I made from last video when I talked about, I think, the best stocks to buy under $100. I still think that Disney fits that category because risk-reward wise, the reward is much bigger than the risk currently. And just looking at the graph right now, previously the price we're at today, or pretty close to the price we're at today, has been a pretty good support line in the past. And I mean, we've been around this price for the last couple of weeks. So I think we'll be pretty safe there. Again, tomorrow on Thursday, there will be a CPI report that could create a volatile day. So keep that in mind. And so to conclude, pretty boring report if you ask me. If you listen to the earnings call, you could have fallen asleep as well. I mean, Iger didn't really sound that excited during the earnings call, all things considered, despite his paycheck. But I mean, yeah, there is still a long, long way to go for Disney to come back to their previous glory, if you ask me. Seeing free cash flow positive for 2 consecutive quarters already, huge increase there, is very, very good. But then if you look at the subscribers drop, That's not great. Parks remain pretty popular, but how long will that be dragging the business on and on and on? Things need to improve, and a modest dividend payout at the end of the year won't do the trick. I mean, they're still having to pay down a lot of debt from that Fox acquisition, which was a terrible decision by Iger, by the way. I know a lot of people want to blame Bob Chapek for everything that's gone wrong with the company. But in my opinion, all the issues started with Iger. Chapek came in, pandemic hit, not his fault. And then Iger comes back and everybody's like, oh, he's going to save and everything. I also was a bit of an Iger fan before, but when you read and you listen to the people talk, you see that, well, he's not such a magical CEO as they've painted him to be. So that will be it for this video. Of course, do share your thoughts down in the comments below. As I said, there is more reward than risk in buying Disney at these prices. Whether you're a short or long-term investor, take that into consideration. Leave your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.